Hi guys, Harry back again with another video. So today I want to talk about the differences between trading and investing and why you should not consider trading, why I think people do trade and why some of the reasons that I tend to do it. So as a high time frame trader, you're always asking yourself the question, should I just be owning stuff long term? Why do I put myself through the stress? But these are the reasons why. So I wrote a couple of points down that I'm going to go through today. So I think the one of the main reasons is you can be flexible with your capital. A lot of people are long term investing in assets and they're not being as flexible. So as you can see here, we've got the Nasdaq, beautiful high time frame trend, but as you can see through this period, didn't make an all time high for what, 13 years, 14 years maybe, so maybe even longer. So yeah, in that same period of time, and this is on about the flexible capital piece, as you can see here, look at gold, look at that. So you could prioritize your capital there, and yeah, you'd be taking trades on NQ and the Nasdaq, of course, but gold was really moving, so you could be aggressively sizing and scaling your money into that asset class. And the same's happened across all markets. So there's always something moving, and you can really allocate your capital to that. Yes, it can be hard to chase. You need to have a bit of skill. You need to have a plan, a process. But if you can, definitely worth considering. So another one is you can avoid huge drawdowns. As you can see here, GC, whilst the Nasdaq, I guess started to really move, look at that drawdown on gold. Massive. That's a 200-day EMA, by the way. So huge drawdown on gold. You can maybe, let's say, only go long above. So you could have avoided all that period. Yeah, you would take a couple stabs, but yeah, that period you would avoid. So again, being a bit more active, you can avoid those drawdowns. Yeah, you'd have taxes and stuff to consider, but if it's avoiding a 20-30% decline, definitely something worth considering. Another one is, and this is more related to stocks, that there's no forever stock. So as you can see here, we've got Apple, brilliant chart, as you can see there. If we zoom out, brilliant trends, but you could probably argue from that 2023 it's gone up, but if you compare it against Nvidia, that's trended way more. So you'll be able to think of some stocks, I don't know, maybe Intel or Dell, for example, in the 90s that had brilliant moves, and they've not really had that carry on performance. Yes, there's maybe like a Microsoft that's been around for years, but knowing that there's no forever stock, you will always have that invalidation, and you can really again go to what's moving, go to what's trending, and have that flexibility with your capital. You should always have an exit on a trade, and I think trading emphasizes knowing where to get out more than investing does. I think some people are buy, hold, never sell, whereas trading, it's, I know where I'm getting out before I get in. One of the first rules, and it enforces that more. So I feel like that's another positive. And you maybe hold something for a year, 2 years, and then you're out and you're on to the next thing. Whereas you might hold it and then it might come down and wait for it to recover, and you just go down. You maybe add a bit more on the way down, and you're kind of ruining that return. So that's another thing as well. You should do both though. I feel like Chris Camello does speak about this. You should have a long-term kind of stack and a more aggressive, risky stack of money. So you can actually do both together. So it's not like if you're a trader, you don't long-term invest and vice versa. So you should do both. You should always be long. I think like ever since after 2008 in particular, you want to always be long at some stage. Even if there is, a massive drawdown, you do want to be long. But yeah, you should do both, and you can do both side by side, but this can really supplement those long-term investments. And the last point is trading can be a bit more predictable than returns. So if you've got a track record over the last 5 years, let's say you've done an average of 20%, then you can confidently say in that 6th year, you're going to be in and around that 20% mark. Whereas you're leaving it to chance if it's in an asset. Yeah, you could say, well, the stock market's done on average, 10%, so I would expect it to do 10%, but it's not as much in your hands as it is with trading. You're the ones making the decisions. You're not just putting your money in and kind of letting it ride the waves as such. So hopefully this video has broken down some, of the reasons why people tend to trade on the high time frame and why maybe you should consider it too. So thank you very much for watching, and I'll see you in the next one.